Hi, everyone, and welcome to our webinar today. My name is Verena Radulovic. I'm a Vice President for Business Engagement here at C2ES, where we are the Center for Climate and Energy Solutions, where we're otherwise known as C2ES. We are a nonpartisan, nonprofit research organization committed to advancing climate solutions and the technologies and policies that promote them. And we do this by advancing business action on climate through our Business Environmental Leadership Council, which is a group of 40 Fortune 500 companies that are committed to addressing climate change through reducing their emissions and making investments in low carbon technologies. A part of our work with companies is providing feedback on regulations that affect them. And we've been very extensively involved in providing comments to the SEC's rule when it was first introduced as a proposal in 2021 as an idea, and then again as when it was proposed in 2022. And we've seen it through and tracked it when it was finalized on March 6th. So today we're going to examine much more closely the recently finalized climate disclosure rule by the U.S. Securities and Exchange Commission. And what we're going to do is I'm going to be first joined by Eric Girdning, Director of the SEC's Division of Corporate Finance, Corporation Finance, to discuss key questions we've heard from companies over the past few weeks. And then after we hear from Eric, we'll be joined by some senior leaders at Duke Energy, Dow, and GE Vernova to discuss how their companies are approaching the rule's reporting requirements. So Eric, thank you so much for joining us today.
Thank you for having me, Verena. Thank you for hosting the event. Let me start off, Verena, by just doing our standard disclaimer. The views I express today are provided in my official capacity as the Commission's Director of the Division of Corporation Finance, but do not necessarily reflect the views of the Commission, the Commissioners, or other members of the staff.
Got it. So, Eric, what I'd like to do is there are a couple of questions that we're going to start with. And in the 4 or so weeks since the rule was finalized, there have been a number of questions that have come up. Many of the companies that you will hear from later today are preparing to report to the rule, and many leading companies are already doing things that the rule is asking for. But if I could ask you to give a quick recap of the final rule and highlight the main changes that were there from the proposal.
Sure. So as an initial matter, Verena, I wanted to bring up a few substantive framing points as to what the rules are intended to achieve. First, the rules are focused on investor needs and providing investors with information that they need to make investment and voting decisions. Investors are already demanding and using a lot of the climate-related information that the rules would require. And many registrants are already disclosing the climate-related information the rules would require. But what the rule is intended to bring, which is not, the Commission found is not necessarily present, is consistency, comparability, and reliability to those disclosures. Given our time limitations, I don't think I have time to go into every provision of the final rules. For an overview of all those provisions, I would point you all to the fact sheet on the Commission's website. That being said, here's some of the main categories of the provisions that the Commission adopted. The first category are disclosures in something called Regulation SK. These are disclosures outside the financial statements. They tend to be narrative disclosures on climate risks, risk management around climate risk, strategy, and corporate governance. But these Regulation SK disclosures also include qualitative disclosures and metrics, including material Scope 1 and Scope 2 GHG emissions for certain registrants. Second big category of rules that the Commission adopted are assurance reports. For those registrants who are required to disclose Scope 1 and or Scope 2 GHG emissions, they would be required to obtain assurance reports from third-party independent parties. Third main category are disclosures in Regulation SX, which governs financial statements. And then the fourth category are other provisions, including safe harbors from private liability for certain forward-looking statements that the rules would require. In terms of changes from the proposal, there are several, and I point you to page 31 of the adopting release for an in-depth overview of those changes. But as a general matter, the final rules are less prescriptive than the proposed rules, and are also explicitly qualified by materiality in several places. which might be a good segue to the rest of our discussion, Verena.
Yeah, Eric, thank you. One of the questions that has come up a lot is on materiality. And the SEC states that, scope 1 and 2 emissions should be reported if they're material. There are a number of other provisions that are based on materiality. How should companies be thinking about materiality, specifically when it comes to their scope 1 and 2 emissions? And what I'm looking for is if you can provide any hypothetical examples of where we would expect to see companies reporting material scope 1 and 2.
Sure. So the standard of materiality in the rules is the same standard of materiality that the Supreme Court has articulated in relevant case law and that the Commission has adopted in several rules, including Rule 12b-2 and Rule 405. So the Supreme Court stated in several landmark cases, including TSC Industries versus Northway and Basic versus Levinson, that information is material if, and here's a direct quote, if there's a substantial likelihood that a reasonable shareholder would consider it important in making an investment decision, or if it would have significantly altered the total mix of information made available. So when the term material appears in the final rules, including with respect to scope 1 and 2 emissions, it's referring to that traditional notion of materiality that securities lawyers are very well familiar with. Materiality is a facts and circumstances-based inquiry. That's why we generally highlight the standard itself rather than give prescriptive examples of what would be per se material or immaterial. The adopting release does, however, give some examples of situations in which scope 1 and or 2 emissions may be material. So, according to the release, a registrant scope 1 and or 2 emissions may be material because their calculation and disclosure are necessary to allow investors to understand whether those emissions are significant enough to subject the registrant to a transition risk that will or is reasonably likely to materially impact the registrant's business, results of operations, or financial conditions in the short or long term. Second discussion in the release, a registrant's GHG emissions may also be material if their calculation and disclosure are necessary to enable investors to understand whether the registrant has made progress toward achieving a target or goal or a transition plan that the registrant would be required to disclose under the final rules. Conversely, the fact that a registrant is exposed to a material transition risk does not necessarily result in its scope 1 or 2 emissions being de facto material for the registrant. For example, a registrant could reasonably determine that it is exposed to a material transition risk for reasons other than its GHG emissions, such as a new law or regulation that restricts the sale of its products based on the technology it uses, not directly based on its emissions. Such a risk may trigger required disclosures under other provisions of the final rules, but may not necessarily trigger disclosure of scope 1 and or 2 emissions.
Okay, thank you. I want to actually shift to scope 3 emissions because that was a big deal that the SEC removed scope 3 from the mandatory reporting. However, I'm curious if, for example, a company uses a transition plan to manage its scope 3 risk, but the scope 3 emissions themselves are not required to be disclosed. Does that company need to disclose the transition plan? Are they required to disclose scope 3 metrics? So help us understand the dynamic around scope 3 a bit more.
Sure. So I have to underscore the rules do not call for disclosure of scope 3 emissions, as you noted. And the release specifies that in no circumstances is scope 3 emissions metrics disclosure required. Regarding your question of when scope 3 may be relevant to transition plan disclosure, it may be helpful to go back to the text of the relevant portion of the final rules rather than having me discuss the question in the abstract. So if you look at item 1502E1, that provision states that if a registrant has adopted a transition plan to manage a material transition risk, it has to describe that particular plan. That disclosure requirement is not limited to a particular type of transition plan. For example, it is not limited to transition plans that are associated with scope 1 and or 2 emissions. Where a registrant has adopted a transition plan to manage any, quote, material transition risk, it will need to describe the plan. This would include a description of what the plan covers, but it does not necessarily require quantification of the matters covered by the plan.
Mm.
Therefore, if a company's transition plan includes reference to scope 3 emissions and the related transition risk is material, the registrant may need to describe qualitatively how the plan contemplates management of scope 3 emissions. This would also be true for an emerging growth company or a smaller reporting company that has a transition plan related to scope 1 or 2 emissions. It would also be true to the extent that scope 3 is part of a registrant's material targets or goals.
Okay. So let's talk about those goals. How should companies approach reporting if or when goals change over time?
So I think, again, it's helpful to go back to the actual reg text, Verena. So item 1504A requires a registrant to disclose any, quote, any climate-related target or goal if such target or goal has materially affected or is reasonably likely to materially affect the registrant's business, results of operations, or financial condition. The registrant will make that disclosure as of the relevant point in time of its applicable filing. So the disclosure will reflect the relevant target or goal as of that particular point in time. If a target or goal changes over time, then the disclosure in a later filing would reflect the revised target or goal. The registrant would likely be required to highlight those changes to the target or goal in its disclosure because of two things. First, item 1504B requires a registrant to provide, quote, any additional information or explanation necessary to an understanding of the material impact or reasonably likely material impact of the target or goal. And second, item 1504C requires disclosure of, quote, any progress made towards meeting the target or goal and how any such progress has been achieved, and requires that disclosure be updated for each fiscal year. In addition, a target or goal may remain the same over time, but its materiality to the registrant may change over time. The adopting release recognizes this, noting that no annual update of a previously disclosed target or goal's progress under item 1504C is required if, for example, that target or goal is no longer material.
But if it becomes material at some later point, then it would be introduced and it would be reported.
If it later on at a subsequent filing date does become material, then disclosure may be required.
And just as a reminder, can you just give a brief update on the safe harbors that are applied to the forward-looking statements?
So the Private Securities Litigation Reform Act already has safe harbors for forward-looking statements. And what the commission did in the release is clarify and extend that that safe harbor applies to forward-looking statements that are embedded within scenario analysis, the use of any internal carbon price, and other disclosure that may be required.
Okay. I do want to talk about scenario analysis because that was also one of the revisions in the final rule that I think it was a bit more streamlined in terms of how companies would disclose their scenario analysis. But let's say a company uses several different scenarios that show materiality, where only one shows the materiality of the emissions and or climate risks specifically. What kind of details would the SEC expect to see in the narrative description of the scenario analysis?
Sure. So once again, I'm going to start with the actual reg text. Under item 1502F, scenario analysis is only required to be disclosed if, one, the registrant uses it to assess the impact of climate-related risks, and two, the registrant determines, based on the scenario analysis, that a climate-related risk is reasonably likely to have a material impact. If scenario analysis is then required to be disclosed, item 1502F requires the registrant to describe each such scenario, including a brief description of the parameters, assumptions, and analytical choices used, as well as the expected material impacts, including financial impacts, on the registrant under each such scenario. Use of the word such before scenario in the second part of that sentence, as well as a requirement to discuss the expected material impacts under each such scenario, indicates that only those scenarios in which a material impact is expected must be disclosed. Thus, I think your question gets at if a company is examining multiple scenarios and only identifying one in which a climate-related risk will have a material impact. In that particular scenario, item 1504F would only elicit disclosure about the disclosure that is reasonably likely to result in a material impact. As to your question about what would be expected in the narrative disclosure, I would again point to the rule text requirement to include a brief description of the parameters, assumptions, and analytical choices used, as well as the expected material impacts, including financial impacts on the registrant under each such scenario. Registrant should keep in mind the Commission's statement in the adopting release when it adopted 1502F, because if a registrant has used scenario analysis to assess and manage a material climate-related risk, investors need to understand how it conducted that analysis in order to evaluate the registrant's conclusions regarding material impacts on its business, results of operations, or financial conditions. Registrant should ensure, therefore, that the disclosure sufficiently provides investors with that understanding.
So Eric, one last final question on that one. If you have multiple scenarios, let's say a company conducts scenario analysis using 2 or 3 scenarios, and each of those scenarios, all of them, show that there is a climate-related financial risk. Do they have
material?
Material, right. So let's say all 3 scenarios provide a material risk. Do they give a narrative on all 3 scenarios, or do they pick one of those?
They would have to give the required disclosure on each of those material scenarios, unless the assumptions and parameters are the same for all 3.
Okay.
But if I think that would be unlikely. So I think that they would have to give similar brief disclosure for all 3.
Okay. All right. Well, Eric, thank you very much for joining us today. We really appreciate it. Is there anything else that you'd like to share with the audience before we shift over to the next panel?
No, thank you very much, Farina.
All right, thanks. I'd like to welcome the next panel to the screen, and we're going to shift now to hear the perspectives of 3 companies that are preparing to report to the rule. One thing that we've noted for those of you that are tuning in, we had about 200 companies register for this webinar. So if you are listening, I have to assume that many of you are either familiar with this or potentially new to this world. And so what I'm looking forward to in this discussion here is for these 3 climate leaders to talk about what they're already doing and to provide some best practices and lessons learned for those that are new to this. So we're going to go ahead and get started. With me today, we are lucky to be joined by we have Vicki Sullivan, who's the Director of Climate Policy at Duke Energy. We have Pam Oberski, who's Vice President of Global Financial Accounting and Reporting at Dow. And we have Roger Martello, who is the Chief Sustainability Officer for GE and GE Vernova. So thank you all 3 for joining. I'm going to go ahead and get started with Vicki, but we're going to go ask the same question of all of you, and then we'll go and ask some individual questions. So Vicki, starting with you, what aspects of the final rule is Duke already implementing?
Well, thanks, Farina. That's a great question. And fortunately, we at Duke Energy already disclose information among many aspects of what the SEC will require in the final rule, especially with respect to our Scope 1 and 2 emissions, our targets and goals, as well as narratives around our assessment and management of climate-related risks. We currently disclose these in our annual sustainability, what we call now impact reports. We also disclose them in our annual responses to CDP for climate. Of course, that used to be called the Climate Disclosure Project. Now it's CDP Climate. We also do every other year or biennially climate reports where we also disclose this information. And in the last two climate reports, we've done scenario analyses. And then finally, we last year did our first comprehensive physical risk assessment. And I'll talk more about that in a little while.
Great. Thank you, Vicki. So I'll hand over to Pam. How is Dow approaching the final rule? What is it that Dow is already doing, and potentially what aspects of the rule do you think will be easier for Dow to implement, and why?
All right. Well, thank you. Very similar to Duke, we have been publishing an annual ESG or sustainability report for many years. So we've had a longstanding practice of tracking our Scope 1 and Scope 2 greenhouse gas emissions. So for us, that piece of it is easy to comply with. We have a process in place to collect that data. We get assurance on that information. And so that's a very established process for us. In addition to that, in our annual ESG report, we do a lot of reporting under TCFD, which is one of the frameworks that heavily influence the SEC standards. So much of the required disclosures under TCFD are already in our ESG report. So that piece of it makes it, I would say, easier for us to start this whole process of what to put in the SEC filing, because we have most of the framework and the basis for that already established. Just thinking ahead to the financial impact of disclosures needed as part of this rule, we have some processes established internally already to track weather-related events. So we have the core structure around how to get that information, but now we're looking at the rule to make sure we can appropriately define and make sure it meets the requirements of what the SEC is looking for. So that's a little bit about what we're doing and what's maybe easier at the moment for us to tackle.
Good. And Roger, GE, global company, what are the aspects of the final rule that GE is already implementing or already reporting on?
Rena, thank you. And thank you for including us. And I think like Dow and DuPont, it's fair to say that there's some overlap with information that we've been voluntarily reporting and sharing with our stakeholders. And, you know, if you did the Venn diagram of the SEC rule, you'd see some overlap there. So we've had some muscle, but on the topic, but I would say it historically has not been enough to kind of come into where, you know, you're in a regulatory reporting regime and all the consequences and the certainty and the details that come with that. I think we've known for some time that we're moving from a world of voluntary reporting to mandatory reporting. They're even though there's some commonality, they're two different things. And so we've been thinking about, I'd say going back a few years, how do we prepare for this inevitability of when the day would come, which is now coming, whether it's SEC, EU, California, or other things, where this is no longer voluntary, mandatory, and how do you use that muscle you have in the one place and train to get to the next? So I think we've been taking very much this training approach, less focused on individual rules like the SEC or the EU, but how do we get our house in order? How do we build the building blocks so that when these rules come down the pipeline, which they're doing right now, we're going to be ready to be able to answer these questions. And one thing we've come to figure out is there's only so many ways you can ask these questions, whether it's EU, SEC, other people, they're all getting at basically the same core information. They may ask the question a little bit differently. So we wanted to build those building blocks. And what we really did is we said, let's take the toughest filter here. Let's do the thing that's the hardest. Because if we can meet that, then hopefully, I wouldn't use the word easy, but the burdens become more manageable as you're dealing with these different regimes. So being a multinational company, we've long focused on the EU. The EU came out a little earlier on this. I'd say it's probably a bit more burdensome than what the SEC is doing. There's not a full kind of comparison there. The SEC is doing some things the EU isn't, or so on. But you can see we're setting the standard as what's the hardest thing to do here? Because if we can prepare for that, we should be in a better position to prepare for other things. So we took this building blocks, get your house in order approach, and we're going through mock exercises right now. Even though we've reported a lot of this and we can report a lot of this, we want to move that muscle through the training to be ready for this world of mandatory regulatory reporting. And so that includes a lot of internal work. How do we focus on data quality and making sure the data going from voluntary reporting to mandatory reporting is at that caliber of financial reporting? How do we get it to the same quality as financial reporting? How do we have the right governance around it, both the inputs, the management, and the outputs? How do we transition to quality assurance? How do we have the state-of-the-art systems? And what we're doing is we're looking at 2024 as kind of a mock exercise for what's to come in 2025 when the data really matters. We have to start reporting in a variety of systems in 2026. And one thing we did earlier this year is we had something called a Kaizen event. Some of the folks on the phone may know that, others may call it something different, but we decided we were going to take a week together, and we took about almost 100 employees from all around the world. We all went to the same place, our headquarters in Cambridge. We broke into 5 teams, and we said, let's break down all these governance procedures from where are we jumping off from the quality of the data to the quality of the recs, to how we communicate this and take that to that next level. So I wouldn't say we're there today. I think we've made a lot of progress, but this is the year that really matters for us, because this is the year where we're practicing, where we're making that transition from voluntary to mandatory. And then we have next year, is the year that we're really under the regimes, whether it's EU, SEC, and so on. And we feel like, no matter what question somebody asks us, we'll have the basic core data in place and be able to respond to the format that the various regulators are looking for.
Super helpful. And what I'm going to do is actually, Pam, I'm going to go to you to talk about Dow's internal systems. Thank you, Roger. And then Vicki, to you, because I have a question for you on physical risk. But Pam, building on what we just heard from Roger in terms of thinking about the building blocks for not just the SEC, but this sort of broader context, I'm curious from Dow, what internal systems were already in place and which ones will need to be further developed to be able to report the required information? And why don't we just say focus on the SEC for now, but with Roger's
So I'm going to cover greenhouse gas emissions because that's probably the one that's most relevant for this conversation. I don't think Dow is unique from many companies where today much of that data that we collect, it's in offline spreadsheets performed by a number of individuals across the company. We have a lot of manufacturing sites. The calculation of that data occurs at that manufacturing site. And then we roll that data up to a core team that reviews it, aggregates it, pressure tests it, that all the right formulas were followed. And so, like Roger mentioned, we've been putting a lot of controls around that process. Who prepares, who reviews, what are the key controls that need to be adhered to, much like in financial reporting, to make sure that it's external worthy and auditable. So we've done that. The other thing that I think is really important to that process is you have to adopt whatever approach you're going to use for calculating this data. So we did that quite a while ago. We follow the greenhouse gas protocol, the operational control approach. So we've set that as our standard, and that's how we've been preparing that information. We are trying to move towards a system, a more efficient way to get to this information and data and make it more real time. And we're working on that. It's not ready yet. But like I said, I don't think we're unique as I talk to other companies. I think this is how most companies start out. And then as you become more sophisticated with the information and your reporting, I think we're all looking to move to more automated solutions to do this.
helpful. Thank you. So I want to pivot just a little bit because one of the main focal points of the proposed rule that got a lot of attention was the emissions calculation, the emissions data. One of the biggest critiques on Scope 3 was that the data quality wasn't there, and so there was a lot of focus there. But I'm really curious to look a little bit deeper into the physical risks, because as we think about what this rule is trying to do, it's really trying to unearth what are the risks that companies are facing from physical risks, transition risks, and the emissions are contextualized in that broader risk lens. Vicky, I'm going to turn back to you because Duke Energy is a massive utility in the United States. Power is a significant portion of the country and is no stranger to weather events. And so I'm curious from your perspective, how is Duke Energy assessing its physical risks? And then I'm curious your perspective on the revision to the regulation SX, where they scoped it down significantly to just focus on costs and expenditures related to severe weather events, in addition to RECs and offsets. But that was a big shrinkage from what they had initially proposed. I'm curious your perspective on physical risks for Duke.
Sure, thanks, Verena. We have been actually for about 4 years looking at physical risks. We're fortunate that some other companies in our industry, namely Con Ed, I'll shout out to Con Ed, because they did really what I view and what we viewed as the first comprehensive look at physical risk for their system. And it's been 4 years ago now, started on a journey to start looking at physical risks to our system. We ended up doing a comprehensive look using an outside consultant at physical risks to the transmission and distribution system for our company in the Carolinas, which is our largest service area. So we finished that report with the consultant in the fall of last year. And it went all the way from looking at sea level rise, flooding, what are the likely impacts on, for example, transmission lines, if heat is higher than it's been in the past. So all of those things we looked at using IPCC scenarios, and then use that vulnerability assessment to develop a methodology for incorporating that into future decisions about, for example, one of the things we've done already, because we had flooding due to hurricanes, was build walls around substations that were prone to flooding. So this assessment will help us to determine where that needs to go in the future. So we feel like we're in a good spot from that. Obviously, we're looking to expand it. And then as to the cost of physical risks, the regulation SX, we already do, as a result of requirements from our public utility commissions, disclose information about hurricanes. Obviously we operate in the Carolinas and Florida, which are prone to hurricanes, and we're looking at what additional tracking will be required for compliance with the rule and how the 1% thresholds will affect what we typically spend. So
are there areas where if the SEC developed further guidance on that point would be helpful, or do you feel like that Duke has what it needs with the way that the rule is written to report on expenditures related to extreme weather events?
The one thing we've talked about internally is, it's basically the SEC is looking for information on both income statement related expenditures, and then for capital expenditures, the thresholds in the balance sheet. And, fixing, the transmission or distribution system after a hurricane, that's fairly easy to quantify. But what capital expenditures you're making, and this gets back to a lot of the questions around the proposed rule, you're making capital expenditures to build a wall around a substation. Is that due to climate change? Is it due to severe weather events that are in the SEC's requirements here, or is it due to other reasons? So some of that, would be helpful.
Additional guidance.
Yeah.
And Pam or Roger, did you have any thoughts on that before I move on to the next question?
I was just going to add, I do think the capital piece is something that we're looking at. We don't have it's something we just really haven't tracked at that level before, a severe weather event, capital related to that. We do it for expense, but not in capital. So that is a piece that we're going to have to develop, and we're working towards that. So that's maybe, and what I struggled a bit with in reading the rule is the definition around severe, so I think we'll need to be really clear on what we define severe as so that it can be applied consistently across all of our sites across the globe.
I would just echo Vicky and Pamela's comments. I think those are exactly the right areas where some clarification and guidance and reassurance would be helpful.
So actually, I want to just pull on that thread just a little bit, Roger, and talk about harmonization before I shift to Pam and Vicky on questions on goals. One of the things that you brought up earlier in the webinar was kind of this broader tapestry of regulations that we're seeing. We're seeing California, we're seeing the SEC, we're seeing EU CSRD, and we're also seeing the emergence of reporting requirements across other jurisdictions, other countries. Where do you think harmonization is most needed? Because a lot of the disclosure is similar enough, but different levels of detail. I'm wondering, Roger, if you have a view on that, and then if others want to chime in.
It's a really thoughtful question. And, I think I'd say at the outset, I imagine for a lot of companies, we're all in favor of disclosure. Of course, we want disclosure that's the most relevant, the most useful, the least misleading, and frankly, balances, burdensome. Everything's going to be burdensome to some extent. We're not going to argue that it can't have burdens, but it should be considerate of burdens and things like that as we look at what's most helpful. And so for a company that's looking at this with this lens of, we look at the EU, the CSRD, double materiality, which we can chat about if anybody wants to talk about that, the SEC, California, ISSB, and we have the feeling we're just getting started here. I doubt this is the end of it. We do step back, and while we're happy to disclose and we'll comply with anything anybody asks us to comply with, they won't get an objection from us. We do, ask, is this really the most efficient way? And is this actually not only a question of burdens, but is it really a question of what are we trying to get at and what are we trying to communicate? I thought it was very interesting hearing Eric's comment. He was so definitive on this is all about the investors. And that makes sense to me. I guess this is the SEC. It is all about the investor. I haven't quite heard it maybe that directly before. And that to some extent makes sense. I don't tend to think of it with that lens myself. I try to think, are we communicating in a way that I think of, like I don't know if it's a good example or not, like my 16-year-old daughter who cares a lot about this. Like, could she read our report and get a sense of what our impact is? And if she were to read our EU report, would that help her, or would it make her confused? Is it apples to apples or apples to oranges? And I think at the end of the day, while it's important to communicate to our investors, and we should, I think Eric's point was fair on that. I think we also have an obligation for clarity. It does us no good if we're reporting different types of information in different ways and just leads to confusion and people roll up their hands and like, I just don't understand this. Or it can frankly lead a company to be saying, well, you said this over here one way, you said over here the other way, then we got to explain it. And yeah, those internally inconsistent, it's not ideal. So I understand why the SEC is doing this. I think I understand why the EU is doing it, but I would really call on all these folks to try to get together and start to harmonize here. Not that, I would say I get the EU has to do what it has to do and so on. There was some reference to harmonization, the SEC rule. It was in there. I was happy to see it. I thought it was putting out a little bit of an olive branch. And I'm not suggesting come 2026, we're going to have one global system. That would be nice. Probably not realistic, but we should, I think, push on that. I think we should aim for that, not only because of the burdens on companies, but I do go back to the fact, what are we really trying to do? Who are we trying to communicate with? And what's most helpful to them? And I don't think these competing kind of patchwork quilt of regimes, you called it the tapestry, I'd probably be a little less optimistic about it, is really the most efficient way to get information across, not only to investors, but to customers, to stakeholders, to our employees, and frankly, to the folks who just really want to understand this and have it done in a way that promotes clarity and consistency and brevity at the same time, and impact, and focuses on impact too.
Good, thank you. I'm going to pivot just a bit to Pam and Vicky, and Roger, you're welcome to chime in, but about goals. And then I'm going to, as we sort of end the webinar, I'm really curious if people can think about one piece of advice that you would have for companies for whom reporting this information will be new. So I'll come back to that last question, but have that in your mind. I want to look at the climate goals because I think, focusing very much on what needs to be disclosed, but Vicky, can you paint us a picture of what Duke's climate goals are, what they encompass, and how they've evolved more recently?
Sure, Verena. Happy to. As I mentioned earlier, we've had a target to reduce carbon emissions from our electricity generation, actually for over a decade. I looked back at our sustainability reports. I wasn't with Duke at that time, but our first mention of a climate-related goal to reduce emissions was in our 2011 sustainability report. So we've been in this business for quite some time. We've upped the ambition of that target for carbon emissions from electricity generation, which actually represents about 70% of our scope 1, 2, and 3 emissions. So obviously that's been a real focus for us. We most recently upped the ambition of that target in 2019, where we adopted at least a 50% reduction from 2005 levels by 2030, 80% by 2040, and net zero by 2050. In the last couple of years, we've added other goals as well. First, we added a goal for reduction of our methane emissions from our natural gas business unit. These are typically fugitive emissions from natural gas pipelines, valves, and so forth. We have a net zero goal for those emissions by 2030. And then in year before last, I believe we added goals for scope 2 and certain scope 3 emissions. We added those to our net zero by 2050 goal, and then have an interim goal for those in 2035 of a 50% reduction. So we have a variety of goals, and with those, we feel that we're covering more than 95% of our scope 1, 2, and 3 emissions.
All
So
right.
that's where we are on goals.
Okay. And I want to kind of building on what Vicky's saying, Pam, I want to get your perspective on goal setting. You know, what are the different factors that are driving Dow to take action on climate? I'm curious to look at kind of the stakeholder lens, because we've been focusing a lot on the compliance piece. And I think there's a concern that, at least C2ES issued a concern that, oh gosh, would required reporting have a chilling effect on those companies that haven't yet set a goal? And I'm curious if you can kind of build on kind of the context that Vicky provided, and what sort of pressures does Dow face when it comes to setting a climate target?
Yeah. So similar to Vicky, we have goals already established, and we have very long-term goals that go out to 2050. We have short-term and medium-term goals, and we've been providing these for many, many years, not because we had to, but voluntarily, because it was information that our stakeholders were requesting. To get to your question around just why do it, I think every company needs to be a good global citizen. You need to do what's right for the world. And in many cases, it makes good business sense. Your investors, your stockholders, the communities you conduct business in, even your employees are asking for this information to help aid in their investment decisions. So, I think this helps get that out there so they can be more informed, but also shows that companies are taking it seriously and taking actions to, improve some of these areas.
Thank you. Roger, do you have any views on what you just heard?
No, I would, agree with all of that. I think there's a variety of reasons to why we would set these goals and targets. First of all, we start with what's good for business. I think we have to be clear that succeeding for sustainability, we could have the best goals in the world. If we can't succeed as a company, all that's for nothing. So we have to, first of all, make sure that we're succeeding as a company, succeeding for business. But then we can align our business success to how that helps promote broader purposes. So in our case, we help generate 30% of the world's energy. And so it's good for business for us to electrify the planet and to decarbonize the planet. We have business goals and targets for how many wind turbines we sell and how much grid electrification equipment we sell and small modular reactors for decarbonization. But we can translate that business success into 2050 net zero and scope 3 emissions. And that's another metric that resonates with many of our stakeholders who wants to understand how we're not just succeeding for business, but we're succeeding to help decarbonize and electrify the planet. So I think that's a really key. It's a nexus between the two. It's not, I think, choosing one versus the other, but alignment between how you translate the success for the business to success for broader sustainability purposes. So like Duke and Dow, we have similar types of ways that we announce, 2050 targets, 2030 targets, track those, report on those. And the question will become, as we're having this conversation, now that we enter the world of mandatory reporting, make sure, again, we're getting our house in order. We go through a lot of process and rigor on our voluntary reporting. I want to be super clear on that. But we also know that this is a different universe, different consequences, different expectations, different ramifications, and different expectations in terms of governance and process, similar to financial reporting. And so that's the process we're going through right now.
Got it. So building on that process, and I think I'll tag Pam to go first. What advice do you have for companies for whom reporting this information is new?
So I would just advise, get started now and don't do it alone. It's not a finance sole responsibility. It's not just for the legal team. It's not just for sustainability. So get a cross-functional team formed. You need representatives from really all the functions in your company to evaluate the rules, do the scenario testing, assess the risk. So you're going to want to pull in people from manufacturing, from strategy, from your enterprise risk program, your energy results, and the others that I mentioned around sustainability, finance, and legal. So getting that team formed now, starting to dissect those requirements, and doing what Roger alluded to. Everyone that reports on this today has a very good process around it. It's very good information, but making sure that you have those controls in place, as once you put it in an SEC filing, it has a different level of rigor around that review.
I don't know, Vicki, if you're ready to go next.
Sure. I would add to what Pamela said a little earlier. We started out with the spreadsheet approach too. And, the good thing is that for folks who are starting this now, y'all can start with a more comprehensive approach. I mean, we literally had a couple of years ago spreadsheets that lived on different people's computers. And I remember doing writing a table myself to compare who had reported what for what emissions. And you don't want to be in that situation. You want to set up a, obviously computer-based shareable system from the beginning. So you have it and you don't have to go through kind of the growing pains that some of us did.
Got it. Roger, any thoughts from you?
Raina, I think I'd say three things, and one of them I'll just say briefly because I think I've touched on it. Is I think we have to focus again more on getting our house in order from a governance, data quality, systems assurance approach before we really focus on answering the questions. And I think sometimes there's a temptation to go, right, exactly what is the SEC asking us to do? And that's important to understand it because we have to know what we're aiming for. But until you have your house in order, it's going to be really, really hard to be ready. And I think that's frankly the harder question. I think to me, you asked at the beginning, what's the easy part of this and so on. The hard part of this to me is not answering the question. The hard part is being ready to answer the question, the readiness, the preparedness. We'll take the questions, we'll have the building blocks. But that's where we're putting most of our energy. I spend 95% of my time talking, financial controls, data controls, quality, how we're managing software, auditing, and things like that. And 5% of my time kind of studying the SEC rule at this place. I just need a big understanding of what I'm aiming for. I'd say the second is I would urge folks to not let the time get away from them. 2025, 2026 seems like, okay, that's a few years. And thank you, SEC, for giving us some time. We would prefer that versus less time, as EU moving on the same time frame. But it's also not a lot of time. And you have to count on lessons learned. We're learning lessons. I mentioned this week we did in January. It was a really effective week. We committed on Friday. We're going to walk away from this week. Everything's going to be solved and fixed. Well, here we are end of March, and we're finding out that we've got more issues to solve and fix, and that's good. That's part of the process, but I'm glad we have the time to figure that out. It'd be much more stressful. if we didn't have the benefit of time, if we weren't doing this mock exercise. So I would suggest don't let the time get away from you. I think we'll need every minute of it. And I think the third thing I'd say is we're all going to have to be nimble here. We're kind of operating in a world where we have an SEC final rule, we have an EU rule, maybe California. I don't know how much of this is actually locked in. Things are going to come and go, change, get harder, get easier. And that's why I get back to my building blocks concept. Like I can't predict exactly what we're going to be doing in 2026. I will predict it's not going to look exactly like we think it is today. But if we have those right building blocks, we can be nimble. And I think it's important to be nimble here as folks look at this. I think the EU does this a lot. They propose one thing and then they're like, oh, we're going to change our mind. We're going to extend it. We're going to switch it around. Now we're going to give you 3 months to comply. And we have to just be really nimble and flexible, but know that whatever happens in any one place, this is inevitable. Mandatory reporting is coming. Nothing's going to really stop that if you're a multinational company. And that's why having your house in order, doing the building blocks, we think is really key here for compliance.
I want to build on that. We have a few minutes left here. I just want to build on that a bit. When we think about the internal systems that need to be in place and getting that house in order and being nimble, for many companies, just beginning to undertake the exercise of understanding their climate-related financial risks will be the first step, and probably something that will take them some time. And I'm wondering if anybody here on the any of you can speak to that process. Like how should companies be thinking about that first step of understanding the risks, where they lie, and then you can kind of begin to put into place systems that can report and measure that.
So Verena, maybe if I could take a quick stab at that. I go back to something I said earlier, is we picked the hardest filter. Like that's not something you always do, but we're saying we're going to start making this as hard as possible, because if we can make it as hard as possible, then we'll be able to answer the question. So we look to the EU. The EU requires, as part of their disclosure, something called a double materiality assessment, where you have to look at the way that you're impacting the environment, climate change, and the way climate change and the environment's impacting you. I don't know the SEC technically uses those terms, but a lot of this kind of bounces around that. And so we decided to we had touched on materiality assessments. We had done versions of them. We'd done light versions of them, but we had never done like the full 360-degree double materiality assessment that the EU would make us do anyway. But it gives us a lot of information that kind of becomes the foundation for answering all those questions. I don't know that it necessarily answers 100% of the questions 100% of the way, but it gives you that initial look, at least, of on a chart where the risks are highest, where you maybe need to double click, and maybe some of the things you don't have to focus on as well. So that was really critical to us as being very foundational here. I'm thankful for my team that they encouraged us to do this on day one. And it just, by having that early and ready to go, it's enabled us to spring forward in terms of where we need to double back and take closer looks at some of these risks that the SEC is now asking for.
Thank you. Vicki or Pam, do you have anything to add to that in terms of a company getting started on assessing the climate-related financial risks, both either physical or transition?
Well, I would say that we started with CDP. And of course, CDP, not everybody does it. It's voluntary. But one thing that is useful about CDP is it follows the TCFD guidelines. Basically they say, what are your physical risks? What are your transition risks? What are your processes in place to deal with them? So that was for us a place to start, years ago, actually, where we had been thinking about these risks, not in the level of detail that the SEC, we think, may require for material risks anyway. But we've been kind of using this template that the CDP requires if you voluntarily do it, to lay out what our view is of our physical and transition risks. So using TCFD as a framework, I think, is a good place to start.
Thank you. Pam, you get the last word.
I don't really have anything else to add. We too started with TCFD and CDP. I think those are great places to use as a launching board for what you're doing.
And for those that are that are listening in, TCFD was a task force for climate-related financial disclosure. It was released in 2017, and it was adopted by the ISSB, I think it was last year. So it's now kind of transformed into an international standard. So with that, thank you very much to Roger, Pam, and Vicky for joining me today, and I really appreciate your time. And with that, the webinar is over. Thank you.